morning, this is Stephanie C. O'Connor, Executive News Editor at Hotel Business. We're here this morning at the ALIS 2017 conference in Los Angeles, and we're speaking with David Sonnenblick and Elliot Eichner, principals and co-founders of Sonnenblick-Eichner Company. How about the equity buy-in? I mean, has that shifted dramatically or significantly in what sort of cash needs to get on the table before a lender will even look at a deal?
Well, what's the equity buy-in? So I guess what lenders are looking for today, especially if they're looking at a trailing historical basis, they'll size a loan typically to a debt yield, but they'll max out on some type of loan to value. So typically we're seeing loan to values from Wall Street being in maybe as much as 70% LTV. Feel more comfortable in the 65% range. Life insurance companies certainly wouldn't be north of 65%. For hotels who like to be less. So it may be imputed equity depending upon how long owners have owned the asset. On construction loans, it's hard to, with the land value, to really do appraised land value. They want to know what the real basis is, what the real cash is in the deal, as opposed to saying, I bought a piece of property and I bought it for X $1 million and now it's worth Y $1 million because of appreciation. So the equity buy-in on construction loans really has to be based upon cash basis typically, unless they've owned it for a very, very long time. But as it relates to permanent loans, I think it's more of a loan to value test, and then also subject to what type of cash flows are in place and debt yields are being achieved from the property as it relates to the loan amount that we're looking for.
Yeah, and I think just to add to that if someone is buying something, so what the equity buy-in is, I mean, you're really today looking at, like David said, maybe a 65 to 75% loan. And if you're buying something, they're going to look at the value as being the price that you're paying for it. Sometimes a little bit skewed because if you're buying something, you're going to put capital into it. We can add that onto it. But they're going to take that total cost, which at time will be value as well, because that's what you're paying for it, and lend, maybe 65 to 70%. Sometimes what's the mezz to push to 75. So the equity requirement would be anywhere from, probably in the sort of 25 to 30% range.
Yeah. And that's just interesting because actually to that point, we're talking about conventional financing from Wall Street CMBS, which maybe can push 70%. Life company is going to be less, but there are some private debt funds that will go higher. And you may be able to get them 75 if they like the deal, possibly maybe push 80%. A little more expensive capital, but a little higher in the capital stack.
And that would be a floating rate lender. So a lot of these buyers of these properties, they're buying them. Sometimes there's some upside to it, so you don't want to put a CMBS loan on, although some properties are pretty stable and you want to put a long-term fixed rate financing on the property at the beginning. But a lot of our clients come to us and say, okay, can you get us an interim loan so we can go in, we can get the cash flows up, we can work the property, we can get the upside, and then transfer into a long-term loan.